Hi guys, it's Dan here. In this week's episode, let's talk about the role of central banks. So in this video, you will learn three things. First of all, why do central banks even exist? What is the goal, or what are the goals of central banks? And what tools do they have to achieve their goals? All that being said, ladies and gentlemen, let's move on. Now let's talk about the role of central banks. And to understand the role of central banks, the best way to understand it is to look at the different goals they have. So who are these central banks? Well, first of all, you have the Federal Reserve for the United States. You have the European Central Bank for all the European countries which have the euro, so the eurozone basically. And then, for example, you have the Bank of England for the UK, and also have Bank of Japan and all the others. So what do they do and what do we have in common? Well, let's look at the goals first. There are three big goals, and then there can be little differences depending on the country, but let's talk about the three big goals. The first goal of the Federal Reserve, for example in the US, would be price stability. What does it mean, price stability? Well, basically it means to monitor and to control inflation. What does it mean? It means right now there is a big debate in the US. Is all this money that has been put into the system after the pandemic, will it overheat the economy and will it create inflation? What does it mean? Well, it means, first of all, what is inflation? Inflation is when the average prices go up too quickly. For example, the Federal Reserve, of course, will not monitor each price of each pen, of course, but on a macroeconomic level, so on a country level, they will look at different indexes, how are the rents going up, what about real estate, energy, for example, all the consumer goods, and they will make, well, kind of an average list of all that, and at the bottom you will see the inflation rate. And usually in the Western world, the goal is to have about 2% inflation, which is price stability in this case, because 2% inflation is good for growth, and below would be too slow, and above would be too strong inflation, which would damage the economy in the long term. So this is the first goal. Then the second goal would be for the Federal Reserve, for example, to monitor the financial system and to learn from the past mistakes. And here we have a great example of 2008 with the huge financial crisis which started in the US. What is interesting here is that the central banks, well, they basically create the rules for banks and all the financial markets. So they have decided, for example, after 2008, that banks, if they want to play casino, if they want to speculate a lot, they need to put more into their deposit, because if the entire thing goes wrong, there's still a deposit that will save the entire, well, economy from failing basically. And they're also what is called the lender of the last resort, the central bank, which means that, for example, in 2008, if the entire ship sinks, well, they will handle the situation basically, and they will recapitalize banks and all these things. Goal number 3 is when the Federal Reserve, or all the central banks in general, they are in charge of regulating the monetary policy of a country, which means that, for example, the United States, they have a monetary policy in place, and the Federal Reserve is in charge of carrying out this monetary policy. Sounds super complicated, but actually it's not that complicated, because basically what they do, to make it very simple, of course they're in charge of printing notes, for example, and you see that's why here you see Federal Reserve notes, because only the Federal Reserve in the US is allowed to create US dollars. And of course on an electronic level, because this is like physical dollars, but most money, most US dollars are of course electronic dollars, and this is actually how the entire monetary system will work. Now that we know the goals, I wanted to talk quickly about why are central banks so important. Because actually what we have learned from the last 200, 300, 400 years basically is, imagine if you have no central bank. That means that the government is in charge of the monetary policy. Well, and that's a big problem. You know why? Because let's imagine I need to go to war, or I need to finance or figure out a way how to go out of a crisis, for example. Well, what do I do as a country? If I can print money, well, of course, I'm going to print more money because it helps me with a quick fix, basically, if I need more money to go to war, for example. And this is the big problem, because of course, if you print a lot of money, it will create a lot of problems in your economy, and especially it's gonna increase the inflation, which gonna be bad long term. So the first big reason, and the main reason why central banks exist and why they are independent usually from governments, because when governments alone decide, they make a mess. It's a bit like dictators in Africa, for example, who have an airline. They're gonna decide, okay, first of all, of course I want to have a free ride. Then of course my wife should fly for free, and then my entire family and all my supporters and all that stuff. And you see how it ends usually. So this is the super important reason why central banks are very important, because they are independent, and what they decide should of course go hand in hand with what the government wants. But the central bank is kind of a checks and balance institution that doesn't just print money to make everybody happy. Now that we have understood why central banks are important, or why they exist, and also what are the goals of central banks, well, now let's talk about the tools that they can use, well, to achieve their goals. So as you remember from previously, I just told you that the first goal was price stability. So the first tool for the central banks are the interest rates. Interest rates are fixed by the central bank, so they can decide to up or down interest rates. What's the relationship with inflation? You will see it's pretty easy to understand actually. As I just mentioned earlier, so the goal is price stability, which means monitoring inflation and maybe correct inflation if necessary. First case, imagine my goal is my 2% inflation, and imagine now I see that the inflation is going too high, so 3, 4, 5% inflation. That means that my economy is overheating. So as a central bank, I need to react, okay? I need to go back to my 2% inflation to reduce this inflation, okay? I don't want my economy to overheat. So what can I do as a central bank? Well, in this case of overheating, of too high inflation, I can increase the interest rates. What does it mean? It means that if I increase the interest rates, borrowing for everybody becomes more expensive. So if you are a government, if you are a company, if you are a private individual, borrowing becomes more expensive. What does it mean? Well, if it becomes more expensive to borrow, you borrow less and you spend less at the end of the day because you can borrow less, okay? And when you borrow less and when you spend less, well, guess what? You are consuming less, so the inflation is going back to where it should be. That's the first case. Second case, imagine the inflation is too low. Let's imagine you're only at 0 or at 1% inflation, like right now, after a crisis or in the middle of a crisis. What can you do as a central bank? And we have seen it at the beginning of the pandemic in March 2020. What did the Federal Reserve do? They reduced the interest rates to almost 0. Why? Because borrowing becomes cheaper for governments who need money for all kinds of counterattacks against, well, the pandemic. Companies need to survive, so they need to be able to borrow cheaper. And of course, individuals, well, they need to borrow probably also if maybe they have lost their job or whatever, okay? So the goal here is, of course, if you're able to borrow cheaper, more people will borrow, and which means it's gonna stimulate the economy in the long run again. So now let's quickly talk about the second tool that the central banks have, well, to achieve their goal, which is to buy and sell treasury bonds. So this is a huge, pretty complex topic, so I'm gonna make it very simple by showing you an example, and well, it should be good for that. So what does it mean, all that? So first of all, imagine you have a crisis, okay? A big crisis like the pandemic, for example. In this case, the US government needs a lot of money, right? For everything they have to pay for, right? So what they can do, the US government, they can, what is called, to issue a government bond or treasury bond. It means that they're basically issuing debt. They are saying, I need money and I pay you interest for that. And the Federal Reserve will say, well, great, you can sell me this bond, so you can sell me your debt, and I will pay you in US dollars. So what does the Fed has to do in this? Well, they are buying the bond they are buying the debt from the US government. They are printing money, and with this printed money, they pay the US government, so the US government now has some money. What is the result of all this? Well, there is more money into the circulation because it has been printed by the Federal Reserve and spent by the US government, and all this leads to more money in the system, which means a relaunch of the economy. So as you can see, this is a pretty complicated topic. I don't want to go super complicated on this one because it should still be perfect for all the beginners. So I hope you have learned a lot of things in this video about the goals of the central bank, about why the central bank exists, and about the basic tools of the central bank. I hope it was enjoyable and that you have learned a lot of stuff. So don't forget to like and subscribe for more corporate and market finance content on this channel. I post every Sunday, corporate finance, market finance. Don't forget to like, of course, and I hope to see you soon next week. Bye bye, guys.